Hello, all of you beautiful subscribers. Welcome back to the Chapple Show. What we are talking about today is 9 mistakes that beginners make when investing in the stock market. So this is essentially an updated video about one that I've made before, because we've had some serious beginner mistakes that have happened, especially in the past month here. So anyways, let's get started here. What is number one? This is one that's been happening really recently. And this is what I call the hot tech stock. What do I mean by this? Well, if you're just getting into the stock market, you've probably seen recently from January up until about a month and a half ago, all the tech stocks were on fire. All of the tech stocks were on fire. Nvidia has gone up, 40%, Tesla up 30%. All these tech stocks are way up here. So you're like, hey, why don't I just jump in on this? Why don't I jump in on this hot tech stock? So there's two problems with that. One of which is you've already missed out on most of the growth of that stock. And two, a lot of these tech stocks are super overvalued right now. And tech, for the most part, we are coming to the end of this economic growth cycle. At the end of this stock market growth cycle, the sector that always gets hit the hardest, apart from occasionally, last one was real estate got hit the hardest, but the one that usually gets hit the hardest is tech. Tech is one that always goes down tons. Like sometimes financials are worse, 2008, real estate can be worse too, but tech always goes down every single recession. Okay, so buying into these hot tech stocks, I mean, we've even seen this recently, even during this bullish trend for all these tech sector stocks, we've seen some like Snapchat go way down 30-40% since its IPO. Blue Apron's down already after its IPO last week. GoPro's been way down for essentially like 2 years now. And all of these hot tech stocks that are trendy and just because it's cool to invest in, like GoPro is really cool to invest in, right? GoPro is super cool. I love their videos. I love their cameras. I love what they're doing. But at the end of the day, they're a company that can't turn profits. Like they cannot make as big a profits as they should be making. And plus they're in a competitive space. And just because GoPro is the cool new company, just like Snapchat was the cool new company, does not mean that they're good companies to invest in. Gotta at least, we're going to get into another tip here. I was just about to mention it, but we're going to move on to number 2 here. We're going to move on to another one here. So don't buy into this all hot tech stock hype. Sure, you could have had very good returns, but it's not sustainable. As someone who has been investing for years and years, Dad's been investing, we do separate investments. I know some of his, he knows some of mine, but he's been investing for 30, 40 years. He's seen the same trends. He's always done very well. He's had a similar strategy to me, and it's never been go into all the tech stocks. In fact, I don't even know if my dad owns a tech stock, period. I don't know if he ever has. Actually, I should ask him that. I don't think he's ever brought up a tech stock before. That's really interesting. I'm going to go ask him. But don't buy into this hot tech stock crap. Stick to the 80-20 rule or the 70-30 rule, 70 to 80% in safer stuff, 20 to 30% take a flyer on in tech or whatever you want to do with it. Okay, so we're going to move on to number 2, which is speculating early. So this is good and bad, and it'll kind of lead into the next one here. And so speculating. So essentially what I mean by that is not buying stocks that have dividends with no guaranteed returns. So you're essentially just betting on stocks where you're just hoping it goes up over time. Just because you have a hunch, maybe you've done some research into it. And so when you do that too much early on, one of two things happen. Okay, one of which is going to lead into our next topic here, so I'll wait. But one of the things that happens is, what if you're wrong? What if the stock goes down? You get emotional about your money, right? You get emotional about your money, and then you sell, and you never invest in the stock market again. That's usually what happens. I mean, in 2008, I think, the dot-com bubble, roughly, there was a few surveys out, 33% of the people who invested in the stock market during the dot-com bubble never invested again. They took all of their money out and never invested in stocks again. They've missed out on all these returns since 2002, 2003, where some companies have gone up 500%. I think on average S&P's up like a couple 100% since then, maybe 100, 200, 300%. They've missed out on all that growth because they were scared that there would be another crash. And there was another crash in 2008. However, the market rebounds. After 2008, rebounds a couple 100% since then. You're getting more and more returns after every crash, no matter what, unless you invest in tech stocks. And so speculating early on is not a good thing. Try when you are just starting to invest, Just invest in safe stuff. Just invest in staples. Put it in McDonald's, right? Put it into financial institutions that, that are regulated now. I wouldn't have trusted them in 2007. I trust them now a little bit more. Put them into financial institutions. Put them into companies like Coca-Cola. They're not going to go bankrupt. Even if everyone starts hating sugar and all their profits go down, guess what? Coca-Cola is going to be around for another 20 years minimum. So put it in some safe stuff. And here's the other thing, is that if you do speculate early on, another thing that happens is this thing called overconfidence. So anyone that started investing in January into tech stocks and had 30% returns, they're probably really confident. They're like, oh man, I'm such a genius. I put all of my money into tech and it went up 30%, and all of a sudden on my $10,000, I have an extra $3,000. So good for you, okay? Whenever someone has a gain in the market, that's really good. I have no problems with that. However, as we've seen recently, tech got hit a little bit. Tech is down. Now what's this person thinking? Oh, they're questioning themselves. Oh, there's been 3 or 4 horrible tech days in the past 3 weeks. They get overconfident. So what if you got so confident to the point that you're buying on margin for these stocks? Or maybe you're putting all of your money in these stocks. What if you bought Tesla? Maybe you've been gaining so much over the past 4 months that you put all of your money in Tesla. Guess what happened? Tesla has gone down 20% in the past 3 weeks. And you've lost all that investment that you put into it in the past few weeks. So overconfidence, speculating, these are common stuff that we see all the time when you are just starting out. So anyways, just be wary of that stuff. I think we're going to move on to number 4 here. And this, again, goes along with the same stuff. This is just an update because I've seen a flood into the tech sector. I mean, I get so many emails all the time, messages all the time. All you guys want is advice in tech stocks, tech and apps and internet companies. I mean, I know that this is the way the world's going, but guess what? You shouldn't be putting all of your money in there. That's a stupid strategy. So this leads into the not diversified or diversifying. Not diversifying is a stupid mistake. Ask your parents who invested in tech in 1999 how that went. It's not good. Ask all the people that invested in real estate, all their money in real estate in 2007, 2008. That didn't go well, all right? If you put all of your eggs in one basket, it's not going to turn out well. I don't even recommend putting it all into one basket for, even real estate or oil or whatever you want to put it into. Spread it out. Buy some ETFs. Buy some entire market ETFs so that you are diversified, so that you're covered if one sector tanks. Because guess what? I was looking this up. The tech sector from the dot-com bubble in a lot of areas hasn't fully recovered. In some subcategories in the tech sector, it hasn't fully recovered. I mean, guess what? Nintendo and Sony, they're massive companies right now. Sony, again, gaming systems and TVs and all that cool stuff. Nintendo, gaming systems, all that stuff. They are worth like 80% less than they were in 2001 than they are today. They're worth 80% less than they were 16 years ago because they haven't recovered yet from that super hyperinflation. So if you were to invest all of your money into that, you still wouldn't have made your money back in a lot of those tech stocks. So don't go all in. Diversify. Diversify, okay, when you are investing. So we're going to move on here to number 5. We've talked about this, which is margin. This goes along the same lines as overconfidence. Buying on margin, having a margin call. So you get so confident to the point where you've only been investing for 4 months, 5 months, and you're like, oh my God, I've been getting 40% returns in tech. Let's buy on margin. Let's borrow the bank's money. That's what buying on margin is. Let's borrow the bank's money that I don't have to invest more into stocks because I think it's going to go up more. That is stupid. That is stupid especially when you're a beginner, okay? If you're advanced intermediate like me, I would be confident buying on margin right now. I don't do it, but I'd be confident in myself and my abilities so that I could buy on margin. Because here's what happens. If your stock goes down more than X percent, 10%, 20%, 30%, the bank has the right to sell all of that stock, make all of their own money back so they don't take a loss, and you lose like 60% on that. So buying on margin and having overconfidence is stupid. Absolutely stupid. I mean, if you're a beginner. Again, like hedge funds, they buy on margin, they buy think that they borrow 10 times the amount of money that they actually have in their fund. Sometimes more, sometimes less. But I heard a lot of those billion-dollar hedge funds, multi-billion-dollar ones, they'll actually borrow, for every $1 billion, they'll borrow $10 billion from the bank, or $1 billion from the bank, or $3 billion from the bank. And that's one of the reasons why they grow. Excuse me. So we're going to move on here to number 6. Number 6 is the actually, I'm wording this terribly, but I'll explain it. The non-profits. Okay? Investing in companies that can't turn profits, can't turn big profits. Okay. So there are a few case examples. I'm going to give a counterpoint here. So usually a lot of tech companies, we'll give the example of Facebook. Facebook wasn't turning a lot of profits in 2006, 2007, 2008. It was in a lot of debt, but it was growing. It was figuring out how to monetize its platform. What happened 2009, 2010, 11, 12, Facebook turned into a billion-dollar profit machine every single year, multi-billion-dollar profit machine. So a lot of these tech companies, they start out not making profits. And guess what happens to most of those companies? They fail. A lot of them fail. Now you got some juggernauts that will probably turn profits in the future. You got like an Amazon that's probably going to turn a profit in the future, maybe 5 years from now. Well, I think I think it's already turning profits, but it has so much debt that people aren't counting it as a profitable company yet. I believe that's what's happening with them. But for example, Tesla. Tesla has a long way to go, like years before it turns profits. We're talking a long time down the line here. We're talking at least a year or two before it starts turning profits. And so buying a lot of companies that don't turn profits, Snapchat's another one, Twitter's another one. Companies that cannot turn profits and you are thinking that they're the greatest company in the world, this is backwards. This is not how you should be investing. This is not how Warren Buffett invests. Warren Buffett's the opposite. Warren Buffett invests in companies that turn large profits, that have large profits, but for whatever reason, mismanagement, whatever, their funding companies going bankrupt, they have a lot of debt or whatever reason that may be, they are down, so Warren Buffett just buys into them. He buys high profitability companies. And so by buying all these companies that can't turn profits, you're taking risks. That's what you're doing. You're taking risks that they turn into Facebook. And right now, a lot of those companies like Tesla, they are valued like Facebook, but they haven't turned a profit yet. So this is what I'm trying to get this through your head, guys, is that, you know, for me, I think Amazon's the only company that I've invested in ever that that essentially doesn't turn profits. I'm trying to think of any other ones. I actually don't know of any other ones that I've invested in that don't turn profits. So again, if you're a beginner, invest in companies that have profits. And this is another thing too, because if a company's turning lots of profits, has a lot of cash reserve, it means that they're not going bankrupt anytime soon. It means that if there's a downturn, then they're able to survive it. If there's a stock market crash or they don't have access to capital, they're able to survive for 5 more years. Apple has $300 billion in cash reserves right now. If there's a recession, they're going to be fine. I mean, if Microsoft, same thing, hundreds of billions of dollars in cash reserve. If some downturn in the company happens, they're going to be fine. Tesla, there's a downturn in them, they're done. They're done. They're not going to have access to any more capital. So anyways, we're going to move on here. We're going to move on to number 7, which is the fast money. People want fast money, don't they? This is just a stupid thing. This is a trend that every single beginner makes. You go into the stock market thinking that the stock's going to double or go up 40% in the next few months. Sometimes it happens. Most of the time it doesn't. You should be investing in the stock market like it's not going to open for 10 years or 20 years or 30 years. Buy companies that are going to be around for a long-ass time and expect slow returns. All right? Expect slow and casual, gradual returns. There's going to be up and downs all the time, but it's going to gradually go up over time. All right? So we're going to move on to number 8 here. Oh, this is what I call the rebound. Betting that a company will rebound. So there's 2 sides to this. Companies like Snapchat, Twitter, GoPro, all those, BlackBerry, you know, companies that have reached a peak at some point, but they're so far down right now. A lot of people think that hey, why don't we buy them now? They're going to rebound. BlackBerry's going to rebound. A lot of the times that isn't the case. A lot of the times they lost their market share to another company. BlackBerry lost their market share to Apple. They lost it to Google. They lost it to all the people that make smartphones. Samsung, right? They lost their market share to them. Can BlackBerry compete with them anymore in the phone space? No. So they're done. GoPro, very competitive space, cameras, phones are replacing them now. You can film better stuff on your phone, on a 4K phone now than you can on their GoPro. They're done. All right, Snapchat, replaced by Instagram. They're done. Twitter, well, Twitter's a different story. They just can't find a way to turn a profit. I mean, it's not that they have large competition. They have a lot of user growth. It's just that they actually physically do not know how to monetize their own platform. So they're a different story. But betting that a stock will rebound in terms of in a time that isn't a stock market crash, that's not right. All right, don't bet that a stock will rebound. Don't bet like I have a good feeling about it. Now, if there's a recession, if there's a market downturn, if there's a sector downturn, then yeah, the sector will rebound. All sectors rebound usually at some point or another, especially during a crash. The best time to invest is during a crash because the stock market as a whole always rebounds. Certain companies do not rebound. That's the moral of that. So we're going to move on to the last point I want to talk about, which is every day. Every day, boys, every day. Isn't Jake Paul have that song? Or no, it's every day, bro. Is that how it goes? I don't know. I didn't watch it. Oh, wait, no. I watched the H3H3 parody of that where, what's the guy's line? Is it like, England is my city? Doesn't he say that? Anyway, we're going to move on from that. We're going to talk about every day. What do I mean by that? It's just something that I mentioned in a lot of my stock market videos. Just watching your stocks every day is not healthy. And it's just going to make you stressed out. There's no point. It's very rare that you're going to need to watch your stock all the time. I mean, for me, the only reason why I pay attention to the stock market is so I can tell you guys what's up in business news and so on. Because you guys like hearing updates about that. I don't even look at my own portfolio every day. I look at it once a week and I talk about it on my website. That's roughly it. You don't need to look at your stocks every day. It's just going to stress you out. Some days it's going to be down. Your portfolio is going to be down 3%. Sometimes it's going to be up 3%, right? But in the long run, you're going to see that 0.1% gains every single week, that 0.05% gains every single week. And over the course of years, that's how you are going to get a good return. So anyways, I'd like to thank you very much for watching. I'd like you guys to check out my stock market program. The link's in the description below. If you want to see my portfolio, what I'm investing in, things along those lines, how much I'm investing in, what companies, stock breakdowns of certain stocks, company breakdowns, financial breakdowns, all of that stuff, it's all down below. So click that link and check it out. I'd like to thank you very much for watching. You're all very beautiful people, and I'll see you guys in the next video.